Hi there, everyone. Good morning. Thanks for starting your day with us. I'm Avan Dabaj. This is The Market, and with me is our managing editor, Nikunj, Dalmia, as well as Ajay Sharma. And you've got quite a bit of green on the screen yesterday. We wrapped up the day with a flourish, to say the least, as we conquered the 17,900 mark with conviction, a nice gain of about 0.5%. And it was across the board as well that you saw the traction picking up. So heavyweights like Bajaj Auto, Bajaj Finance, SBI Life, L&T, JSW Steel, all really supporting the markets. The Nifty Bank as well, it was a commendable move with a solid 7% gain. So safe to say, Nikunj, that we closed the April series with quite a flourish. I mean, the March series.
Where are you joining us from? Aren't you supposed to be in the studio?
I am supposed to be in the studio, but this is the marvel of technology, Nikunj.
And it is the marvel of the Indian markets, Avan, that we've seen a solid comeback in the month of April. What a comeback it's been. Exactly a month ago, we were discussing, debating, deliberating a breakdown trade. Now, what are we focusing on? A breakout trade. And the breakout has happened. 17,700, 17,800, a bit of a wrestling match has happened in last couple of days, but eventually I think it's the bulls who got an edge now. And believe me or not when I say it, and purely based on data and anecdotal evidence, that even though markets have seen a straight line move, 1,000 points on the Nifty, about 8-9% on the Bank Nifty, rollovers are low. Yeah, rollovers are low. Optimism is just not there. Naysayers are there. Disbelievers are there. And that's a typical point which I continue to maintain will continue to fuel the markets higher. So like I said at the beginning of April, it's time to go bullish, it's time to stay bullish, and it's time to stay invested. This market, I think, in this leg of rally is not done with its peak. The peak is yet to come. The best way to navigate is to stay in this market. Don't look at the noise, because the temptation to look at global cues and sell in the month of May and go away is going to be there. But I think it's that pattern which we need to understand, from an oversold market to a market which will be fueled because of skepticism, and then there would be participation. I think we are in the phase 2. The phase 3 is yet to come.
In fact, Nikunj, you'll be surprised that though we are talking about the best series in 6 months, the mid cap and small cap end of the action has been even higher, almost 8-10% rebound coming in the mid cap, small cap end of the market. To a large extent, this optimism in India, or I'll say a healthy dollop of positive global cues, also have been on the helping side. A lot of economic data has been on the lower end, the engineered slowdown we've been talking about, and that is giving market a hope that perhaps this weakness in economic data could hold the hand of the Fed. Can it really? Anurag Singh is joining us from Chicago to analyze the Q1 GDP, which has actually missed the mark by a wide margin. 1.1% is the US GDP, which has come in, estimates were around 2%. And even the PCE data, which the Fed tracks very closely, has decelerated. Is it reason enough to cheer? Anurag, you track that data very closely.
Ajay, morning. Ajay, the story actually lies below the headlines. I understand GDP is 1.1, but we all know that the economy can be in a slowdown, but yet inflation can persist. And that's a bigger problem called stagflation. So if you see, all the indicators are that the inflation is persisting. Look, I understand it dropped from 4.9, the core PCE, to 4.6. But that's nothing to cheer or a reason for Federal Reserve to stop. I understand, and I belong to the camp, this is a very hated rally, Ajay. And many of us have sat this one out. But the reality is that there is nowhere to go ultimately, because at 20x, the earning multiples, the markets are expensive, and inflation is really persisting. And I can give examples on the Coke results, Pepsi results, you name it. They're all hiking prices by 12%, 10%, and their volumes are dropping 2-3% every quarter, right? This story can't go on, Ajay, without something giving up.
So, Anurag, what's the assessment then as to how you're expecting things to trend then when it comes to the US markets? Just taking a look at the fact that there are talks about earnings recession. Are those actually worries that one should be cognizant of?
So Avan, the interesting comment from the Coke CEO this time was that, and he was asked exactly the same question as to, do you see a recession? And he said, look, we don't see any recession at all. And if we get the wage hikes, eventually we'll have to pass that cost on to the consumer. But we are not willing to stop just because there is a recession, which always seems to be 2 quarters away. And even that's the situation now, Avan. So earnings are not dropping. It is the same story that we are seeing for the last 5, 6 quarters. Market expects that the earnings will drop. Well, how will the earnings drop? Because the consumer on the street is still holding the jobs good. It's a cycle ultimately, Avan. If the employment market holds, consumer spends. If the consumer spends, earnings grow. Employees go back and ask for a raise. The raise is ultimately passed on to the consumers. Top line of the companies grows. I think we are not able to break that cycle, Avan. So ultimately, I'm not surprised. Opportunistically, we are also trying to play the market. Whenever it hits a bottom of like 37, 3800, then it rises up to 4200 on S&P, and then we ultimately hit a ceiling, and there comes some bad news, and the market drops back again. We are kind of stuck in a range, but unless something gives up, as I said, either the inflation gives up or the earnings drop happens. Earnings don't seem to be dropping unless there is a severe recession. So we are just kind of caught in a cycle. We'll have to kind of persist and play within this range, Avan.
Right. All right, Anurag, thanks very much for joining us and explaining the importance of this data and how perhaps market is reading it. Let's move on and talk about a host of big earnings which have come in. A lot of them actually came in after markets are yesterday. That's a big roundup for you. Tata Consumer, Bajaj Auto, Anantraj. I think there's some issue on that one. This is the previous day's plate. Anantraj, Bajaj Auto numbers are already done. But we are talking about IT big ones.
So,
big IT
Ajay,
numbers.
what is the common thread here? 4 companies, reasonable size, they came out with numbers post the market hour. Tech Mahindra, miss on margins. LT or LT Mindtree, if I may use the new name now, numbers have not been great. It is also clearly not immune to the demand weakness which is there. Emphasis, a complete miss. So bottom line here is that all IT companies, the big ones which have come out with numbers post the bell yesterday, they have not been up to the mark. And this time around, the IT numbers really have not been an easy one to call. While the sector per se is contracting, that's the headline what we've got, whether it is from TCS, Infosys, Wipro or HCL Tech. But within that, there are some bright pockets, Emphasis, Mastech, KPIT. But in general, I guess for the traditional IT services, the traditional companies which are dependent on the BFSI space, which are dependent on the US economy, they are feeling the heat right now. So IT, at least the numbers, the names on your screen, those companies have disappointed. There is no earnings downgrade and no earnings upgrade. Then the other one is Axis Bank. Axis Bank also, the momentum seems to be peaking out. While operationally those numbers are good, but the fact that the base effect has kicked in, and I think that is clearly visible in what the management seems to be indicating. But the number which has surprised everybody, Indian Hotels, 32% margin for the quarter gone by. Q4 historically is not the best quarter because your Christmas ka chutti and a New Year ka chutti, that happens in Q3. This is a time when you actually may not see a huge uptick, but they've delivered 30% margins plus, and the management underlying tone and tonality, I think, continues to be robust. So if you're talking about a stock where I guess the outperformance will continue, it will be Indian Hotels. Stocks where you will see pressure largely because of underperformance, I would say expensive mid-cap IT names, especially LTI, Mindtree and Emphasis. And Axis Bank, I would say, is neutral because they had informed the markets, and in that interview, Amitabh Chaudhary had acknowledged that growth has already peaked out.
Yes, and I'm also going through the IHCL numbers. Nikunj, it's been nothing short of wonderful, and we'll of course be getting the management on board later on today. But in the meantime, let's hear it out from a top market voice. Banks are looking at like a good investment opportunity, according to Tushar Bora. He's the co-founder and fund manager at MK Ventures. We spoke with him yesterday. Let's listen in to a slice of that conversation.
So banks which have a strong liability franchise will continue to do well. Even NBFCs for that matter, selectively we should be looking at, because since the start of the rate hike cycle, in general NBFCs have not done that well, and there are pockets of opportunity in NBFCs also. But yes, large banks with strong liability franchise will continue to get their more than their fair share of business as well as do well in markets. I would not go underweight on financials, not yet. See, if the Nifty has to move to a new high, financials have to play a very important role. So I would certainly look at financials to, continue to lead the direction, the positive side. So I wouldn't go underweight on financials. I would just say that, in fact, across sectors, I think it's more important to be very choosy and selective, discerning in what you are owning, rather than to try and take a overall sectoral call. So I would continue to be bullish on financials. Just look more closely as to what I'm owning at a given point. Infrastructure, I think we are in the midst of a cycle right now. The valuations are still quite attractive for a lot of the infrastructure players. We are clearly in a seasonally strong execution quarter. Q4 earnings that would get reported, I believe we'll see good traction across the board. And next 1 year, infrastructure should be a good space to own. FMCG, I'll be more selective. I think while earnings look good so far, whatever has been reported, but the valuations, still are much higher than comfort for a number of these stocks. So I'd be more selective in FMCG. I'd be more willing to go, say, aggressive in pharma at this point. Capital goods, manufacturing-led themes. These cycles have started. Railways. We've done one round where everything has gone up. I think we will see another cycle in IT over the next 6 months. A lot of IT mid caps have not done that badly on results. If, for example, ER&D companies, results have actually been much better. So only the large cap side, the frontline stocks have done much worse in terms of earnings. But IT, I would bet that we will see a bottoming out in the next 1, maybe 2 quarters, and a start of a fresh new cycle.
Now 17,900 Nifty, SGX is indicating it could be 18,000 plus. Who's going to be calling the shots today? It's clearly the bulls. Duresh, we have seen bit of an arm wrestling in last couple of days between the bulls and the bears. Looks like the battle finally, or the puck finally has moved with the bulls.
So very clearly, right from the start of April. So we saw that March end selling, and post that, say from 29th, 30th March, it has been bulls all the way. So we've gone up more than 1,000 points. We've gone up almost 8 to 10% in the small cap index as well. The mid caps have also done well. So it is not something where it is just the heavyweights, it's across the board. So that's the kind of momentum you need to break out resistance levels. And we've taken out 17,800, 850, and next we go towards 18,200. And once that crosses, we get into a much stronger uptrend, which is where we go all the way to 18,600, 18,800 also. And the way to play a trend is to continue to stay with the trend, keep your trailing stop losses and ride it on, because markets has a tendency to surprise on the upside as well. So overall, the view remains positive. And with the new expiry, I would expect more stock specific action even on the derivative names as well.
ब्रेकआउट तो हो गया अब
No, actually, you were talking about arm wrestling. I thought it was finger wrestling because the bears did not had any power in the last 1 month or so. I think except for that 200-point correction or a blip in between last week or so. I think other than that, it was all through the way bulls for the April expiry.
No, but Kunal, 17,800, 17,900 in a sense is where you've gone again and again and you've come down. This was the first time you've gone past that mark with a thud. Global cues are strong, crude is down, dollar index is supportive, FIs are buying. So all the ingredients in the melting pot are saying that finally khichdi pak chuki hai.
Well, yes, absolutely. And all the hurdles which you said, so for example, 17,800, these are pit stops for the markets. Now, for example, the next level which you are looking out for is 18,200, which could be the next pit stop for the indices. And once we come closer to that 18,200 mark, I think we are going to spend some time on the indices over there. So we won't be surprised that the markets actually consolidate for a week or so at the 18,200 mark. But with every rise on the index, with every new pit stop of the hurdles the markets are coming closer to or breaking past, there is a sort of encouraging data points every time. So whether it's crude oil prices dropping by, equities across the globe, for example, yesterday the Dow Jones recovered quite smartly, about more than 500 points. So when you have such encouraging data points, it's just going to add more fuel to the rally. So I think all in all, the view remains to be bullish. 18,200 would be the next levels on the upside.
Kunal, I'm also curious to talk to you about the Bank Nifty, because the leadership so far, when IT was not working, autos caught up on the later end. It was the Bank Nifty which was doing all the heavy lifting, and that too SBI is still not out with the results. 43,000 odd, 8.5%, 9% gain in this series. What's the outlook there on levels to watch out for? Are we getting into a resistance zone, or we can't say it right yet?
So I talk of two aspects. One is Bank Nifty, banking stocks, auto and real estate. When these three sectors, when they make a strong comeback, when they lead the rally, we say that it's a risk-on move from the markets, because these are the three sectors which tend to perform exceptionally well when there is a sudden change of risk appetite from investors. The other way to look out for is that one of the major reasons for Bank Nifty moving up higher this time around and showing signs of outperformance is you have the likes of PSU banks as well as the large cap private sector banks. Now look at the performance of HDFC Bank, for example, this series. Kotak Bank, which has been a big surprise in terms of the returns for the stock in last 1 month as compared to maybe the last 1 year or so. The stock seems to have come into its own shape this time around. So I think a lot of addition towards the banking stocks, which has managed to not just lead the move on the robust side, but it's been more stronger as well as more durable for the indices. So I think it's just going to get better. Hopefully, if the other private sector banks also tend to participate, and assuming if SBI also delivers some good results and probably the stock breaks past about the 600 mark, we are going to see much more higher levels for the Bank Nifty as well.
All right, that's Kunal sharing his views on the Nifty Bank, but let's nail it down to those individual stock strategies. And you're looking at large caps clearly, Kunal?
Tilt towards large cap names, specifically Reliance Industries, a stock which has been a lot more silent. I think it's time that the stock can also start to participate. So what's bet on Reliance Industries from current levels, 2450 as a target, stop loss at 2340. And the second would be a barn, Glenmark Pharma, something which has done exceptionally well. The stock has crossed the 550 mark yesterday. Would expect a continuation up move for the stock. 566 as an immediate target, stop loss at 540.
All right, and two buy recommendations from your stable as well. Naresh, let's find out what's on your radar.
So first is a buy on L&T. Continue to like the stock. The stock has shown a lot of relative strength and is waiting for that breakout move into an all-time high. Good enough base done. If you look at the other names in the capital goods space, we recently saw Siemens hit a new high in the last couple of days. Expecting L&T to actually get into a sharper momentum in the next few sessions. A minimum target price of 2,500 and the stop loss at 2,250. Second is a buy on Apollo Hospitals, which is a structural trade shaping up after a year and a half of consolidation. The stock has been contracting in a tighter range, a classical contraction pattern, triangle formation, which has a breakout above 4,500. Buying at current levels makes it a good risk reward. An initial target price would be 4,900. Later on, it could go all the way to 5,500, 5,800. So looks like a good risk reward trade here with a short to medium term view.
Let's talk about the big newsmaker of the moment, and that is Raymond. Look at the Raymond stock price in the last 1 month, 45% gains coming in. And now look at the stock price yesterday, a good 8%. Why? Because we told you day before yesterday there's some big strategic announcement which is expected. Yesterday the announcement actually came through, bit on the expected lines, but details coming in, and also a lot of restructuring which was announced along with the Raymond GCPL deal. Vinny is joining us to talk more about that, what our brokerage is saying after this particular 3,000 crore deal, and also what does it really entail for shareholders going forward. Vinny, tell us.
So absolutely, first let's just talk about the Raymond GCP deal and then about the restructuring. So Raymond GCP deal, obviously GCPL is acquiring Raymond's consumer care business, where Raymond Limited actually held 48% stake. Now this acquisition is going to be for around 2,800 crores. It's an all cash consideration which GCPL will be paying Raymond, and this is for those two brands and two categories that covered in this is sexual awareness as well as the deodorants brand, which both are currently growing in double digits as well. Acquisition is made at around 4 times that of FY23 sales of Raymond consumer care brand. Now obviously what does this mean for in terms of Raymond is that obviously they have a lot of, they'll be able to pay the debt off as well. Around 900 crore debt is there as on December 2022 on their books, so they will be paying off all the debt, and the remaining amount that will be there of around 1,300 to 1,400 crores approximately, that will be all used in the Raymond lifestyle business. Now this Raymond lifestyle business, this is a restructuring that is happening. So under Raymond Limited, we have branded textile, branded apparel, cotton shirts as well. All that will go into Raymond Lifestyle. Raymond Lifestyle will be listed as well, and all the money that they're getting from GCPL will be used in a Raymond Lifestyle, and that will be under Raymond Consumer Care, which is going to be listed as well. So obviously in terms of Raymond Limited, there will be mainly a real estate company which will be there, which will be mainly focusing on real estate as well as the engineering business, and for that every shareholder of Raymond 4 shares of Raymond will get, they'll get 4 shares of Raymond for every 5 shares that they're holding in a Raymond Limited. So Raymond Consumer Care, they'll get 4 shares over there. Branded textile business is going to be coming in RCCL as well, and do not forget what is important is that in terms of the promoter holding also, that is also going to be changing, and they've given a structure as well. So in RCCL, that is Raymond Consumer Care, currently the promoters are holding 48% stake. Post this whole restructuring and change, promoters will hold around 54.8% stake in the company. So that is also an important factor that we should be keeping an eye out on, and also that the full amount that they're getting from GCPL will be reinvested in growing the lifestyle business.
There are going to be 2 critical stocks that we'll be watching out for in today's trade as well. Thanks very much, Vinny, for breaking that down for us. In fact, my colleague Anurag Joshi interacted with the managements of GCPL as well as Raymond. Let's hear out what they have to say.
What will be the promoter contribution to the lifestyle and real estate business?
100% of my equity holding in the consumer company, I am leaving back in the company. I'm not taking a single rupee out of it. So my 50% of the sale proceeds will stay in Raymond Consumer Care, and as a promoter, I am putting 100% of my sale proceed back into the business.
So you're putting it back into the lifestyle and the real estate business?
Absolutely. And which is a very strong statement to show my commitment and belief in what the company will do.
For the 1,400 crore rupees, can you give us a sense about the breakup? How much would be this 1,400 crore rupees that the promoters should have invested, that 1,400? Can you give me a sense of the breakup about how much is going into lifestyle, into real estate?
Actually, we have to understand the 1,400 crore is the sum of promoter contributions into the business. The first one of 350 crore was done in 2019 when the land of the promoter sold. The second is this, which is 1000 plus crores, which is the promoter share on the sale of FMCG, which again goes back into the lifestyle business. So to that extent is this 1400 crores. So there is, you cannot define whether this is a business, the 350 crore what we put in 2019 was relating to lifestyle or for the reality business. It was Raymond Limited.
And you also spoke about the 100% promoter contribution. I mean, can you give an idea about that?
100% promoter contribution means whatever share of the promoter on the sale proceeds, 100% of that proceeds has gone into the business. It is not 100% of the value because the promoter held only 49%. So whatever the value coming out of the 49% has been put into the lifestyle business in RCCL.
It's a full cash deal and we'll make the payment quite quickly. We're figuring out between our cash on our books and the amount of money to borrow, but it's quite easy for us given our cash generation situation in GCPL. So that one we're figuring out over the next few days what the right balance is, but it will be an all cash deal and it will be consummated pretty quickly.
Right. Let's analyze that transaction a little more in detail. Himanshu Nair is joining us to discuss the Raymond deal. Himanshu, talk to us about what does it really mean for Raymond shareholders. They are the ones which are getting the proceeds. Promoters not even taking their share of money out, infusing it back. The stock was mighty excited. Do you think the further benefits can be seen coming to the company post this transaction?
Yeah, hi, good morning. Thanks for having me here. So clearly, this is a positive for Raymond shareholders on two fronts. Firstly, the valuation at which Raymond has been able to sell this business is quite a big positive and much ahead of our expectations, given the small size and the suboptimal margins that business had. So getting almost a 5-time price to sale valuation, of course, is a big positive and which gives additional cash to Raymond shareholders. And the second point is with the promoter showing this confidence in the company by increasing his stake at these at around the current valuation and not taking away any money home is again something which should give confidence to shareholders that the apparel business is on a very solid footing. And given the fact that now the company will become debt free, the promoter is increasing his stake, the structure is much more cleaner. Now investors have the option to separately invest in the apparel related businesses. All those could be re-rating drivers for the overall business. And therefore, despite the run-up that we have seen in the last 1 month or so, we clearly see further upside on the stock even from current levels.
So what's your 12-month target from 1700?
So we are still working out the details, but even if we do not assume any re-rating, we still get a target price of, we should be getting a target price in the range of about 2,000 odd rupees. And any further re-rating will give you further upside beyond that.
All right, Himanshu, appreciate your time. Thank you for joining us. Now today, I just want to go back to that whole point once again that most of the IT companies which have come out with numbers, at least the big names, none of the IT companies have delivered strong numbers. Wipro missed. HCL, Wipro miss. Tech Mahindra, margins were under pressure. LT Mindtree, they're not immune to the slowdown. Emphasis, a complete miss. So this becomes like a ripple. The weightage of some of these companies is not strong. Not that anybody is expecting anything large from IT, but that means that IT, which has been an underperforming sector, the contra buyers are unlikely to come. With the Tech Mahindra becomes a special situation stock. Wipro, I think, is still work in progress. The buyback may act as a back support. If you frankly ask me, if one looks at the Q4 sequential growth, that's a great graphic. It just captures the real mixed picture, so to speak. Infosys, big howler. Wipro, contraction on quarter-on-quarter basis. Tech Mahindra, revenue is back, but margins seems to be all over the place. So the picture for IT is not looking great, but the picture for Zomato is looking classic. The stock yesterday went up on strong volumes, above 60. It was at 70 a couple of months ago, so it still has a long way to catch up, nowhere close to its 52-week high. But in last couple of days, it has again pole vaulted from 54, 55 to 61.
Yeah, I think, but if you take the recent low, it was around 44, the last month low.
44 has become 58.
44 has become 60 yesterday.
61.
Yeah,
Yeah.
60.4.
So would it be 70 soon?
Yeah, 75, as we were discussing yesterday as well, that could be a nominal target for Zomato, because that would probably take the stock back towards the 5-month, 6-month high from where the correction started off for the stock price, and that generally becomes a more of a pivot point for the stock price. So I would not be surprised that after this 18% up move for Zomato in the last 3 to 4 weeks, the stock can see a further 10 to 15% upside coming back towards that 70 plus mark.
Okay. Nuresh, I think Zomato was there on your list last week.
It's been there for the last couple of weeks. It's part of the recommendation even today.
A very small and a quick answer, Nuresh. I was hoping for a long explanatory answer.
No, so I'll explain the stock and the reasons for it. So Zomato looks much more, say, promising. Just the say the technical structure is very similar to what happened with PB Fintech, and it is happening with Paytm. So what we generally see is once there has been a huge correction in a sector which is overbought, which is highly, say, tracked by the markets, and then it falls 50-60%. Quite a few names never come back. And the ones which come back actually first go through a period of 8 to 12 months or even longer of a sideways price correction, wherein it gets into a tight range, a range of 20 to 30%, and it just stays there, does not see violent moves. And that is what has happened with Zomato, between 40 to 70. And in the near term, it's given us a short-term breakout about the 57 mark, which was the high for the last almost 3 to 4 weeks. So a classical sideways consolidation, base formation, and then you take a rally. Now the rally has 2 steps to it. First would be a step towards 70, which is the recent high for the last almost 8 to 12 months. And then once it can sustain above 70, then it has a potential to get into a slow and steady long-term uptrend. And this could be a steady uptrend, unlike what we've seen over the last 1.5 years, wherein the stock fell by 50%. And there were a lot of large moves before, but this could get into a steady uptrend. So my view is we are shaping up for this consolidation and a rally up in a few of the new age names. Something like Nike has not done that. Some other names have also not done that. But 2-3 names which clearly are supposed to be the leaders in this pack are Zomato, Paytm, and PB Fintech. And now Zomato has this breakout done, wherein it should go towards 70 in the short to medium term.
All right, there you have it, that long winding answer that we were expecting from Nuresh on the new age tech companies. Tell you what, there's lots more stocks that we want to discuss. We'll do that after we come back from this very short break. Don't go anywhere. Welcome back. Let's put the spotlight on Tech Mahindra, and we've got CP Gurnani, the Managing Director and CEO, as well as Rohit Anand, CFO, Tech Mahindra, joining in to dissect the quarterly performance. Thank you so much. And Mr. Gurnani, I'm going to begin with you because there has been quite a bit of uncertainty that you started the monthly evaluation of demand trends rather than quarterly this time around. Therefore, that's caused that uncertainty. So what is the reading from the latest discussions? Is the demand slowdown structural in nature according to you, or is it just a few quarters of a bit of cautiousness?
On a macro environment, there are trends which are not uniform. The trends like, for example, Australia or Japan or in Asia, or they become better when you come to Middle East. I mean, there is definitely a sense that they are doing better. Similarly, when you are in Europe and US, there are sectors which are doing better than others. So my feeling is that this period of uncertainty will last for another 2 quarters. And we as a company have decided that we'll continue to invest, we'll continue to, look at some of the, trends or what I call the momentum in technology and build on that. So we are launching a massive upskilling program, which we started 2 months ago, because we believe that there is a lot of unmet demand, particularly in quantum computing, in metaverse, in data sciences, and in cloud technologies. So overall, the company continues to be in the investment phase, and I think we will reap benefits in 2 quarters from now because we would be more ready for the future.
Rohit, you are far away from your earlier EBITDA guidance of 14%. Realistically speaking, do you see that happening in FY14?
Yeah, I mean, I'm not, as we have articulated in the past, I'm not giving any guidance on any number, but from a perspective of what we have driven in the current quarter on variable cost and on productivity, we'll continue to drive that. We made certain investments, which is long-term in nature, which is why you see some cost increases in SG&A. I think that will normalize as we move into the next quarter. But overall, from an annual perspective, I think our view on expanding margin, as we said in our investor day in the past and even earlier, continues, and those levers still stand true for us, and not just short term, or in long term basis. We articulated our metrics of expanding geographical reach to Americas and Europe more than the rest of the world, and we continue to work on that on a long term basis and drive some of those areas of growth.
CP, since you are talking about investments, we have seen a sharp decline of almost 4,800 crore headcount in Q4. How would you explain that?
A lot of our headcount, as you know, is distributed between IT and BPO. BPO tends to be seasonal because, when the retail goes down, that some of the BPS work also goes down. So that, I think, is that monthly agility, which is proving that as a company, we continue to be agile and we continue to focus on upskilling and reskilling. Number 2 is that, by definition, when you have 160,000 people and with a 14.8% attrition, there is a certain loss. And at this stage of automation, I have been cautious in making sure that investment is more on upskilling and reskilling instead of hiring and putting people on the job. So I think it's just a fine balance, but overall I think as a company we have got this resource management as a dynamic balancing right. And I do believe that we have finally applied data sciences into our resource management also.
All right, gentlemen, good to have you both on board. Thanks very much for giving us those details. So the period of uncertainty will last for about 2 more quarters, but they are looking at expanding their geographical reach. That's Tech Mahindra for you. Let's connect then with Sandeep Sabharwal as well, who joins in on the fundamentals. Hi there, Sandeep. So much to talk about, but I'm going to pick and choose one stock that I know you are very bullish on, and that's Indian Hotels. I'm sure you have a bigger smile on your face after reading last evening's earnings. 4-fold rise in the net profit, a 32.9% margin, and the management is sounding nothing but more confident down the line.
Yeah, hi, Aman. So, Indian Hotels has been delivering very strong numbers, and I think for some companies, COVID actually helped them because many of these companies were very good brands and very good service companies, but they had cost issues. So, COVID forced them to look at costs very carefully, cut down on costs, and manage costs better. And once the revival has come about and that their growth strategy is working, because of cost control, so now their margins are very good. So I think that's happening in Indian hotels. Results were above expectations. They have done exceptionally well, and they also sound very bullish on future outlook. Although the conference call is clashing with the interview, so we need to listen to the management also in detail. But I think the outlook continues to remain strong.
There you have it. That's the view coming in on Indian hotels. But let's move on because IT is the other big trend that we're tracking. And Nikunj, interesting because those are the stocks that make it to your as number one on the editor's radar. Let's just dissect what we have seen with all the IT majors in terms of the cross-currency growth, the margin picture, deal wins. If we had to break it down from HCL Tech, Infosys, as well as TCS, Tech Mahindra, and Wipro, now that all the numbers have come in.
Look, if you analyze the numbers which came yesterday after the bell, Wipro, Tech Mahindra, Emphasis, LT Mindtree, all of them have come out with poor set of numbers. They've come out with poor set of numbers, and these numbers in a sense are a clear indication that A, there is a challenge with the sector, and B, the management may not be, they're sounding confident, but the numbers and the commentary is just not matching. I first thought that there's a challenge in the sector and the problem was, and Infosys was an outlier, but you are getting a sense that there is a serious challenge for companies which have a high dependence on US and high dependence on BFSI. There are some niche companies which will always do well, so it's a delight to see what a KPIT has done or Mastech has done, but that's far and few. In general, I guess the quarter gone by has been a weak one for the IT sector per se. And why do I have them on my radar? The reason why I have them on my radar is just to magnify that point that I don't think it's time to buy them yet. The management has just about spoken out that there is a problem. So even though we are in a nice uptrend, so to speak, right now, one is better off avoiding them. The second stock on my radar is actually Trend. This has been like a darling. Numbers are not bad at all. There is a miss on the margin and growth because if you do a year-on-year comparison, quarter-on-quarter comparison, because new stores are getting added, the picture in terms of the numeric top line and bottom line will look different. But since margins are a bit of a miss and the stock is expensive, there is a reason to believe that if a stock like Trend, which is trading at a P multiple of 60 times, 65 times FY25, may just settle into what could be called as a time-wise and a mild price-wise correction. Trend has got massively re-rated after Q2 and Q3 numbers, but post these Q4 numbers, while the top line seems to be solid, I think you're getting a sense that large part of the market attention now will shift to other apparel companies like Raymond's or Shriram Fashion or for that matter Aditya Birla Fashion, because Trend has enjoyed the spot in the sun. It is an expensive company and they are going through what could be called as a margin crunch period.
There you have it, dissecting the numbers of the IT majors as well as Trend, and it was a profit this time around that the company delivered versus a loss last year. In fact, curious to get in your take, Sandeep, as to how you're looking at Trend's earnings, given the fact that it has been a challenging demand environment. It's been a mixed operational performance, but all in all, it's been a fairly healthy set of earnings.
Yeah, so Trend operationally has been doing well. It's just that the consumer demand sentiments have been impacted by inflation. All of us know about it. Most consumer good companies have talked about it. And to that extent, it's impossible for some large retailer like Trend to escape that trend. And like Nikunj was rightly saying, it's now a question of valuation. So it's a good company, but trading at high valuation. So the probability that there'll be a phase of consolidation rather than any sharp up move in the near term is the most likely scenario.
What are your thoughts on Axis Bank? I mean, this time round, because there's a City deal also masking the real operational numbers this time round. The stock ended weak going to the numbers, but at 880 odd, how do you see Axis Bank's prospects compared in the large private sector pack?
So Axis Bank is something we got into a few months back because my view was that the valuations are very cheap and they remain cheap even now. Operationally, the company has improved significantly. If you look at their net interest income, their margins, their liquidity coverage ratio, especially their provision coverage ratio at 81%, the excess reserves they are built up of more than 12,000 crores, which are nearly 4 times their overall net NPAs, which are at 0.39%, very similar to HDFC Bank. And valuations are half that of HDFC Bank, almost half that of HDFC Bank. So I think there's significant re-rating potential in Axis Bank. So earnings growth combined with re-rating potential should lead the stock much higher over the next 1 or 2 years. That's what we are betting on.
The best performance in the series gone by, two names which really strike out of the park this time round, unloved for a very long time. One is Glenmark Life and the other is Divi's. Kunal, any of these names which you feel still have good momentum?
I think both of them have decent momentum for themselves. So Glenmark Pharma was in fact apparently one of the stocks which used to move in a very slow and steady kind of a, upward trend from 400, where the stock gave that cup and handle breakout. It's moved on to 500 league, and then now I think yesterday it crossed about the 550 mark. So the momentum is extremely strong for Glenmark Pharma. The breakouts have been successful and the prices have moved up significantly higher. DV Slab on the other hand, even though the stock has recovered from the I think the Feb lows of 2,800 approximately, but I would still believe that the stock has not yet confirmed a bigger breakout above the 200 DMA. So I think that is still pending for DV Slab, which I believe could probably happen another 100, 150 rupees higher from current levels. So 3350, 3400, once that level is taken out, I believe another 200 to 250 points on the upside could be pretty much possible for DV Slab.
Sandeep, why has pharma turned suddenly? Is this pure dead cat bound sectoral rotation, or things could be interesting for pharma? I mean, pharma could do what banks did last 1 year and what IT did in 2021. Could pharma do that this year?
So I think last part is unlikely. First two, a combination of the first two is the most likely scenario. What you said, sort of dead count combined with a rotational funds flow. See, some companies have done well, so and move silently. So something like a Dr. Reddy silently moved to a 52-week high. Sun Pharma has been doing well, ex of the regulatory issues they've got into FDA, and that could impact them in the short term. Ex of that, I think many of the smaller companies have huge volatility and significant balance sheet issues. So we need to be careful where we are investing in.
Pharma companies, I mean, Aurobindo Pharma has debt, but barring that, Sandeep, which are the companies which have a debt issue? I mean, most of the pharma companies are, they generate a lot of cash, they don't have debt on their balance sheet.
Glenmark Group companies, they keep on doing mergers, demergers, etc. So you really don't know what's happening and what's on the balance sheet. So some of the fancied companies like Laurus, etc., they have been growing debt hugely, profits have been falling. And similarly, many smaller companies, we have seen these issues, like you see Ipca at a multi-year low because of the Unichem acquisition. So I think there is a lot of haziness in the smaller pharma company universe.
Area which in the last 10-15 days have really picked up steam is select auto, and that too, that part of auto which has historically not been doing very well. Two-wheelers have started moving. Look at Bajaj Auto. Some 16-17% is the kind of gains in the series gone by. But Hero Moto has actually not moved in the same proportion. If you could compare Bajaj and Hero Moto, you would see Hero is clearly lagging behind. 8% gain versus double that Bajaj Auto, around 17% gain. Nuresh, Hero versus Bajaj, where would you want to bet on from here on?
So it's clearly Bajaj Auto, given the fact that it's outperformed in the near term, and the technical setup is generally to go with the relative outperformers, and they tend to surprise. And if you look at Bajaj Auto, it's a clean longer term breakout. So the stock has gone through a phase of last almost 2 years of sideways period, wherein it went from 3200 to 4300, 4400. Now 4300, 4400 was tested twice in 2021, and now we've crossed that. That's a clear indication of a sharp breakout. And going forward now, 4,200 should be a base for the stock. And ideally, this could take the stock to 5,000, 5,500 also in the long term. Hero Moto, on the other hand, the stock returns have been terrible for the last almost 8 to 10 years now. The stock was at 2500 back in 2014 and we are at the same place. So the only return in the stock has been in the form of dividends, which are decent enough. But overall, clearly the leadership is with Bajaj Auto. Hero MotoCorp is way out of the trend. It will say take a long time. 2800 has been a major problem for the stock for the last 2 years. And that is still a 15% away from the current market prices. So till that point of time, leadership would be missing in Hero Moto. So for now, it is Bajaj Auto, which clearly is a buy at current levels as well as on dips.
All right, let's just focus in then on all the glitz and glamour that took place in Bollywood last evening at the ET Filmfare Awards. My colleagues Aishwarya Patil as well as Shrishti caught up with some stars including Nawazuddin Siddiqui as well as Rajkumar Rao. Let's hear that out.
Well, it's the 68th Filmfare Award and we have with us Nawazuddin Siddiqui. So many thanks for joining us. What does Filmfare mean to you? It's 68 years of fanfare and Filmfare. You might have grown up watching Filmfare. What does it mean to you?
Yeah, of course, it's a prestigious film award. So it's going very good nowadays. So I hope it will continue like this. That's it.
Govinda is performing today, Alia Bhatt is performing. What are you looking forward to the most? And Salman Khan is hosting along with two other co-hosts. What excites you the most about Filmfare?
I will watch all of them and I will enjoy.
Growing up, who was the one actor who you looked up to the most?
Kamal Hassan.
And it's done.
We have Rajkumar Rao with us, sir. How are you feeling tonight?
Thank you. I'm with my director Harsh, who's a beautiful film called Badhai Do.
Yes,
so very excited to be here. He's also nominated.
Yes, definitely. You both are
Everything you would ask me, I'll say he's also there.
How excited are you?
I'm very excited and he's also very excited.
I'm very excited.
Why are you answering on his behalf?
Yeah. I'm very excited.
Shy boy. He feels a little shy in front of the cameras, yeah.
Okay.
Yeah.
He's the man who is behind camera.
He
Who
is
does
so
the magic?
talented. Of course, he does all the magic. He is just amazing. And I'm so glad that he gave me this part of Shardul in Badhai Do. Yeah.
भीड़ भी काफी अच्छी मूवी आई थी आपकी, बहुत अच्छी चली भी. कैसे लग रहा है उस मूवी के सक्सेस के बारे में?
बहुत अच्छा लग रहा है. ऑफ कोर्स थिएटर में इतनी नहीं चली जितना हम सोच रहे थे, पर क्रिटिकली तो बहुत प्यार मिला है, मतलब बहुत ज्यादा प्यार मिला है. एंड सम फिल्म्स यू नो दैट यू आर मेकिंग for people to watch for a lifetime. You know, it's not only for that weekend or that week. Some films are for life, and Beat is one of those films.
बधाई दो के बारे में और क्या बताना चाहिए?
एंड में मैं अपनी फैमिली को बता देता हूँ सब.
जो सबको बताना चाहिए कि क्या कौन क्या है. That's what it is. It's basically it's love is love. Yeah.
Love is love.
एक डायलॉग बताइए आपका जो फेवरेट है हमेशा से.
बधाई दो में.
कौन सा भी?
कौन सा फेवरेट है?
वही हो सकता है, कुछ और हो सकता है.
Fabulous Friday does not stop at Filmfare Awards. There are 80 awards in the evening. So producer will change it next time when the graphic would come. So it's really a true Fabulous Friday, so to speak. We're in conversation with our technical experts. You've got ET Awards, Filmfare Award last night. Just such a busy day, so to speak. Sandeep, you've been critical of a stock, and looks like the tide is now turning for Zomato.
The stock has moved up. Whether the tide is turning or not, that will depend on the fundamental performance. On-ground reports indicate a slowdown, issues with the Blinkit acquisition, etc. So let's see how it goes. So when the tide moves up, then all ships get elevated, right? So that's the saying. So that's what is happening in some of these stocks. Whether it sustains or not, we need to see. So Zomato was always an interesting story because it's just a duopoly with Swiggy, and to that extent, they should ideally be doing much better, but they are not. So I think that's what we need to watch out for.
Last 1 month, Sandeep. Last when we spoke to you, we spoke about Titagar, we spoke about L&T. Haven't got a new idea from you after that. Vatek Babak तो 2022 का है. Indian Hotel 2021 का है. What have you bought in 2023 post March?
you don't sell your winners when they keep on doing well. So I think that's the idea we need to follow. So I think Axis Bank will do well this year. I've been watching that. We've added on to that last 2-3 months, and I believe that now it's set to get re-rated over the next couple of years.
Kunal, Reliance, we were talking about it yesterday, has not participated at all. Has the time come now? Could Reliance be the stock of the month of May?
Well, yeah, I think all things are set in place for Reliance Industries. So a major base, which is at the 20 to 50 mark, that is in place for Reliance Industries. The stock is getting back into the groove in terms of the volumes picking up. The results are out of the way for the stock price. Markets are doing pretty well. So I think the ground is set for the stock to start performing. In fact, in the last 2 or 3 days, specifically going into the monthly expiry, the stock started to shape up quite well. There was evidence of some sort of long rollovers which was happening for Reliance Industries and the covering up of the short rollovers. So that is an encouraging data point for the stock price. Now, what matters for Reliance Industries is that how soon the stock breaks past about the 2400 mark first and then moves on to that 2500 mark. That could be a more comfortable zone for Reliance Industries. So and that's where I think traders would want to create as well as carry on fresh long positions for the stock price. So I believe it may take some bit of more time, but I think 2450, 2500 could be a nominal target for the stock.
And one stock which has really not participated a whole lot but now has surprised a lot of critics is Tata Motors. Look at how it has come back at 480 levels, 20% gain in this series gone by. It is nearing its level seen in December 21. So 2-year high is the kind of level. Last time it peaked out at 290, it's 490. Now it's back at 480. Nuresh, Tata Motors, the momentum, whether do you think there are chances that it may take out that previous highs once again?
So the view is extremely positive. If we look at the structure, the stock has gone through that sideways period which is needed. And mind you, say the stock is available at the same prices as it was in 2014. So it's gone through this huge cycles of pain and gain. And after this recent move, when it went up in 2020-21 to that 500 to 540 mark, the stock consolidated for the last 12 to 15 months. Made a very strong base around 380, 400. There were 6-7 bottoms around that area. The recent highs of 460, 450 got taken out. I would expect 490 to also be taken out and even 540 and go all the way into new 52-week highs and all-time highs as well. So the trend is setting up and the risk reward is still interesting because the last gap up point of 450 should hold on. So I would keep a stop loss at 450 and continue to buy at current levels as well as on dips. This could be starting a structural rally here wherein it could do really well over the next 6 to 18 months.
Sandeep, before we let you go, a quick word on some of the biggies which are coming out with the numbers today. Ultratech, Tata Steel. Any thoughts there? Which one do you think would be a good one?
None of the above. I think cement is having their own issues related to high capacity addition and lack of pricing power. So I think this quarter results could be better than last quarter, but overall valuations are too high in cement. So that's one sector, although the growth outlook is decent, but because of the supply-demand mismatch, I'm not so enthused. And steel is a global commodity, global economic scenario is not as great, so I wouldn't be very bullish.
All right, Sandeep, thanks so much then for joining in, candid as always, and giving us your view on the markets. Let's get in those mid-cap strategies as well. A quick look at the pre-open rates this morning, and it's down about 0.5% or so, circling around the 17,800 mark on the Nifty, with the Sensex down about 300 points. That's the pre-open rate. Let's find out mid-cap strategies. And Nuresh, your top idea?
On Zomato, the stock has gone through a good base formation. Short-term breakout done about 57, holding for the last 3 sessions, good price volume action. Volumes have increased in this move from 55 to 60. I would expect a move towards 70, a buy at current levels as well as on dips. Stop loss at 55 and a short-term target price of 70.
So that's the stock that Nuresh is picking out. Watch out for a target price at 70 rupees. Moving right on then, Kunal, what's your interesting mid-cap call?
So that's a buy on DLF. Again, a very strong breakout for the stock price. I think it's been one of the better performing real estate names so far this month. Would expect a very strong follow through going into the May series. So would suggest a buy. 440 is an immediate target. Stop loss at 410.
Move on then and run you through some of the other top headlines and news that we're tracking then on the show. Amazon has delivered a beat